All right, so going into a holiday weekend, stocks really quieted down after a relatively volatile day yesterday. We quieted down today, which is typical for summer months. It's typical for long weekends. So I'm going to break down today, how noisy the markets are versus whether or not we're getting or expecting new trending moves, and when we should expect to get those in either direction, to the upside or the downside. So I'm going to break down also what's driving the markets here this week, kind of some underlying things that we don't expect, that we wouldn't expect with the headlines that's been out there driving the markets. We might have a little bit more certainty than we think we do. So I'm going to break that down, take a look at a trade idea in a sector that had been really bad performer, but it's been holding up really well here lately. Until we start to get a new trend, we have an opportunity to trade in that sector. So let's go ahead and get started. Today is Friday, May the 24th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off with the market forecast indicator looking at the S&P 500. You can see we finished the week relatively flat today, heading into a holiday weekend, which is not surprising, especially heading into a summer holiday weekend where things tend to slow down a little bit. We continue to hold support here around this 2800 level. Again, there's multiple layers of support near this area. This one, where my cursor is the 23% Fibonacci retracement level of this rally that we've had since the Christmas Eve low point. The Fibonacci fans of that same rally is also, the 38% level is also hitting in this area about right now. And then finally this old low point, this old 1% pullback right here, this dark black line is holding there, and these blue lines are the retracement of that move from that low point up. Obviously, we've pulled back almost all the way into the support area. Now, the idea is, are we going to break through and head towards the next support area, which is at the 38% level, 2820 or 2720 or so, or are we going to bounce off of this and continue to move to the upside? Market sentiment's coming down, but showing very weak bearish trend. So it's not until you get above. It's like when you're watching a best of 7 series and a playoff series, and the old saying that the series doesn't start till somebody wins the game on the road. The trend doesn't really get bearish until it drops below 50. At this point, it's just just like these light pink shadings are not bearish trends, even though the intermediate line's down. Same thing with the market sentiment line. The intermediate line is below 50 though, and that's why we have the dark pink shading here and the red line. A little different scenario than what we saw before over here. We have a lot more volume support in this area now than we did back here, because we were moving up so high with such little volume, and that we were able to get through the support levels here really quickly. We were holding the old 1% pullback low here for a while, and you can see it better on the zigzag chart here. You can see we were holding this old low point for a while, and then we busted through multiple lows. Well, here's that pullback that I was mentioning with the dark black line there. And you can see, we've got a lot of support here in this area for multiple things touching around 2800, a little bit above, a little bit below, but in that area of 2800. And you can see we've had, a 2% bounce, and we've had a 2% drop to yesterday's low point. And we'll see if that ends up being a higher low that we bounce off of and get up to, past that high point. I do think that we can. I don't think that we're done testing in this area down here, but we can definitely continue to push through into this 2800 plus area. The idea was, because of the fans, that this pullback may take us towards the end of May. Well, we're getting really close to that level. We're not quite there yet, as you can see. If I were to put on a few more bars over here to the right, you can see we're not quite there yet, but we're getting there, right? So we can come into this 5 30 area where my cursor is, and still kind of trade in here before we ultimately bounce and make our way. And again, getting back above this 2890 level will be the important level to say, okay, now we have bounced back up, we have moved back higher again. Now we're starting a new multi-month intermediate run, similar to what we saw. And again, these intermediate runs, here's an intermediate run from last year off of the last pullback we had, and we had 3 1% pullbacks during that intermediate run. So it won't be a move that won't have its pullbacks. There will be some ups and downs. You can see over here so there's the intermediate pullback right there. Off of this low point, we had at least one 1% pullback during that. This is an intermediate rally on the market forecast chart. So even though there will be an expectation that we'll start a new rally similar to what we saw, again, what I was showing you was these two runs right here. So that was a 1% pullback. Here we had 1, 2, 3 1% pullbacks. We had a lot of them in this rally. So I expect that we'll get some bounce off of this, similar to probably to something like this, heading into the beginning of June. You remember, from a seasonality standpoint, let's go to a seasonality here. Let's go back 20 years. And we'll just get rid of the drawings for a second. Okay, so from a seasonality perspective, here's the end of May. We tend to have some bullishness, a little weakness around June expiration. Then we rally again into June, right? To about July expiration. Then we have weakness this is again over the past 20 years. So we'll see if that ends up playing out again. If we don't get a little bit of a rally up towards these highs, maybe a little bit higher in July around the holiday there, the July 4th holiday, before we get more of a pullback that brings this green line closer to these long-term averages. Even just on a 10-year chart, you can see we're well above average for the last 10 years as to where we typically are at this time of year. And you can also see too how we tend to have a nice, good bullish move from June, a little bit of weakness after expiration in June, and then up to the July expiration before we flatten out and then have a late year rally to finish off the year. Let's look at the other charts. You can see the same patterns developing. The NASDAQ has its intermediate line now below 20, but its short-term sentiment, the blue line's not dropping below 20 yet. And we are flirting below that low point. The Russell 2000, remember, it's got the most bearish pattern because yesterday we kind of broke down here. A little bit of a harami today with its intermediate line also below 20 and showing a strong bearish posture without the near-term line falling down there. So kind of an interesting pattern to get the green line into these lows, but not the blue lines, the shorter-term lines. If we take a look at the weekly chart here, the weekly market forecast, you can see we have what's called a bullish intermediate confirmation signal here. We obviously have dark green shading and a dark green line. Here, let me get rid of the drawings for a second. So that's a bullish pattern, but we have a strong bullish posture on the intermediate line being above 80, the momentum line down below 20, and the near-term line between 20 and 50. So that's kind of a classic bullish pattern that we would expect to bounce up off of here after this little three-week pullback that we've had. You can see the same thing, similar patterns developing. Not so much we don't have as much of a pullback on the Dow on the momentum. You look at the two, so the NASDAQ and the composite and the Russell, you see the same pattern, bullish intermediate confirmation signal, and then finally on the Russell 2000. On its long-term chart, you can see its near-term line dipping a little bit below 20, and this intermediate line not as bullish. So we're not as bullish here because we didn't go up as much on the Russells as we did on the others. But similar pattern, similar pullback pattern that we're seeing across all these charts that would suggest that we should get a bounce here pretty soon, within a week or two. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen, then hit that subscribe button that pops out. Also, hit the thumbs up icon down below the video. That tells us you want to do the video. You want us to do the video again Monday and day after day. And then comment down below on anything that stood out to you from today's video. Join our Market Outlook email, our daily Market Outlook email list that we have. There's a link popping up there in the top right corner of your screen. Click on that link to subscribe to our email list. Follow me on Twitter for more content in between the videos, and then join our Market Outlook community that we created on Facebook. Also, if you're watching our video here on our blog, right above the video there's a link to our forums, specifically our Market Outlook forum. All you have to do is subscribe to our site to participate there with others that watch these videos. Our calendar over here is on the left. Remember, the holiday on Monday, so this actually picks up on Tuesday. And then finally here we look for 3 clicks. Number 1, click on this heart. That opens up your Twitter account. You can like today's Market Outlook tweet there. You can also do the same thing with Facebook. Again, the more you engage with us on those platforms, the more of those platforms will continue to push you our stuff. Make sure that's how their algorithms work. So we try to make it really easy for you here to engage with us. And of course, you can also like it here on our website, and that engages in our community as well. And again, if you want to subscribe to our email list, just click on fill in these forms here and click on sign up for the daily Market Outlook email there. Very easy way to do that. All right, let's get back to the charts, and we'll take a look at the long-term, the weekly chart here, and you can see how we continue to trade in between the 50 and the 200-day moving averages. That's normal. Probably get another week of trading down towards that 200-day moving average, which is right about where that level. It's like right now it's at what, 2780. So that's right about the low point of that old 1% pullback that we talked about before. So lots of support, including the 200-day moving average in that area. If you look at the Hakinyashi candles, you can see, bearish candles. If you look at, where we closed today on SPY, let's see here. The open for next week's candle will be at 285.32, and you notice we're trading at 282.78. So there's a pretty decent chance we'll get another bearish candle next week, with the low point towards this this 280 to 2. You can see the low point this week was 280.57. So probably in that area, maybe a little bit below 280 with this holiday week before we catch support and bounce back off. That's on the weekly chart. If you look at the 3 green arrows, you notice we are still 3 red arrows, and if you look at those 2 line versions of those charts, we're obviously below still the 50, the 8 and the 17-day moving averages. They're both falling. The MACD and stochastics are both below their moving averages still, but neither one of them are dropping to extreme lows. They're not crossing their midpoints yet either and turning bullish, but they're not really dropping to these sharp levels either that would suggest that we're going to get more of a protracted decline instead of just an intermediate pullback. Remember that the length of this pullback, as we head towards those Fibonacci fans, the length of this pullback is only as big as it is or as long as it is because of the rally that preceded it was so long. When you look at the intraday charts, you can see here's the Hakinyashi Open for this week. Obviously, now it's going to be, next week it's going to be at 285.32. So let's change that to 285.32. So you can see now, we are close to it, but I have a feeling we'll probably still trade within this range. The high point will come down a little bit at the end of next week. Probably, actually, because of the holiday, it will probably still be there, maybe pulling down to this level, which means this midpoint will maybe pull down a little bit. Of course, if we form a new 4-week low point next week, then it will also pull the dotted line down, which is the midpoint of the 4-week range. You can see last week's high was here at 289. This week's high point is right about here, about where that dotted line would pull down to. So this 286 to 287 area is going to be really important next week to see if we get through that. Then we get into the upper half of the range. We get above the prior week's high point, and things start turning around again. Getting above these levels here, getting really above 290, will be like the ultimate signal that we have bounced now. We're turning around. But until then, lots of noise in between there and here, and I expect next week to continue to be just more noise. Again, if you look at the volatility chart, this week here, but the historical volatility is still rising, and it's almost, the implied volatility is almost fallen back below, but we're not really that high on the implied volatility either. And you notice this week we got a 1% down move, and that was here yesterday. 1%. It was just barely more than 1%. And we got a 2% down move over here. But you notice we're not getting, like when we're really bearish, we tend to get big moves to the upside and the downside. And we've had a couple, during this decline, we've had 3 1% down moves, and one of those being a 2% down move. But we haven't had the big bounce back, 1% moves to the upside, which is typical, or 2% moves to the upside while we're falling. Because we get so volatile, and we're not in that case right now. So that's why I'm not expecting us to be too volatile here. And of course, if we break 280, that changes things. But even then, like I said, at 272 is another layer of a pretty significant support that we can fall down and hit, and still be able to find an area to bounce off of. If you look at today's volume and trading range, as expected heading into a holiday, really small, 2 points on the trading range, the volume at 55 million, back to the rest of this week's volume. We had a big day of volume yesterday, but now back down to really low volume down here. So you put those numbers into context. 2 points is down here, 55 million is down here too. So those are both below these averages, which would pull them back down, which would obviously be more bullish than bearish. And then finally, you look at the volatility index here, and we're trading in that neutral zone. We're not really getting, we had a jump up yesterday to these high double digits, but we never did get above this 100% mark, and we're back down into this neutral area. Of course, breaking below 90 would be the signal on this chart that we are bouncing and starting that new intermediate run again. And we're not there yet. I wouldn't be surprised if we don't continue to get some more noise on the VIX as well over this next week. All right, so to summarize, essentially the market's continuing just to be a little noisy right now, and considering the summer, considering the seasonality of things, we're not expecting, and considering the strong support levels where we're at right now, or below where we're at right now, we don't necessarily expect anything to come out of this noise other than just a pause until the market re-engages a new bullish trend. Now, what's going to be the factors that drive that bullish trend? Who knows? And, the global economic indicators can start turning up higher, as we'll see here in a second. Sentiment, this negative sentiment towards trade might start easing a little bit as a trade becomes less of a news-driven headline. People kind of put it in the back seat as, again, it's the investors worry more about uncertainty than they do about certainty. And as long as there is some certainty, and to the point where we kind of know what's going on the trade front, then the market can deal with that. It's the uncertainty of not knowing whether there's going to be a deal, or whether there's going to be new tariffs, or how people are going to respond, and what kind of trade war we're going to have. That uncertainty is what puts pressure on stocks. So it seems like through that uncertainty, we've been a little noisy. Not noisy to the fact that we're now in this big bearish trend, but noisy enough to finally get that exhale that we've been looking for on an intermediate basis. And now some of that uncertainty is going away. Maybe not to the extent to the resolution that we like, but again, the market doesn't care. The market just cares about certainty versus uncertainty. And as we get some more of that, the market might be able to focus on other things that would produce this technical bounce and this new intermediate run that we're expecting here based off our outlook routine. So with that being said, do you agree or disagree with that assessment? Click that link up there. It opens up, there's a link, it opens up a poll, hit either agree or disagree. If you click on disagree, scroll to the bottom and let me know what you're seeing that either would suggest to you that we're going to break the support level. We have pretty decent odds of breaking, or that we might be more bullish, that we might start bouncing here next week. So if you see something in your routines that you want to share with us, make sure you share that down below in the comment section. All right, so like I said about what's driving the price action this week, we have a risk-off pattern here with long-term bonds doing well, gold rallying, but you can see the crude oil really was the biggest outlier to the downside. Small cap stocks and U.S. stocks just in general also down this week. But agricultural commodities were the biggest outlier to the upside. And again, they have been so weak for so long. Even if we just go back to the full year, you can see down here because of their, they kind of reflect sentiment towards the trade war between U.S. and China. And the dollar's been really, really bullish here during this past year, outpacing even stocks. But if you take a look at the dollar index, with yesterday's chart especially, and then continuing with today, you can see it was the biggest loser down here today, and you can see its chart. So bearish candle yesterday that we highlighted in last night's market outlook, and then continuing down, showing that maybe we're not so bullish here on the dollar. And if you take a look at, whoops, wrong button there, the gold contract, after having pulled down to its 50% retracement level, looking like it's trying to bounce and get going back up again. Again, we don't have the dark green shading, we don't have the dark green line yet, so we don't have quite the, we don't have the bullish pattern yet, but that's a good start. And if you take a look at crude oil and the weakness it had down to its 38% Fibonacci retracement, to where there is some support. If you look at the Bollinger Bands for crude oil, you can see there is the volume support in this area as well, not just at the Fibonacci retracement. So of course, its biggest support on volume is down further, but it's a pretty decent move just to get breaking below yesterday, breaking below those lows, and then today holding this level where that little sideways action, that little volume node is holding it so far for support. So you can kind of get an idea of what's going on if you take a look at the 10-year yield. The 10-year yield is pushed down lower, a little bit of a Harami pattern, so maybe we might be forming a low point here for yields, especially considering how bearish they are. If you take a look at the yield curve, the yield curve is starting to slowly work its way down. Now again, it's only, let's look at it on a year basis. You can see it's not been updated beyond, looks like 5/15. So we're, it's this one. It looks like it hasn't been updated for a little bit of time, coming from the Fed database there. But you can see the rest of them are starting to head. In fact, all of them are heading lower, except for the short term, the 3-month, which is the one that's most subject to the Fed and Fed rate hike odds. If we're looking at the rate hike odds, they are now up to, for December, by the end of this year, 77%. They've made quite the jump here at the end of the week. You can see the purple line is the odds of not getting a rate hike. And you can see, let's see if it shows better this way. I don't think it will. I think the line chart's the better. Yeah, the line chart will be better to view. But you can't really see it as well. But the red line is crossed above. So the red line is right where my cursor is. The purple line's dropped down to that 20% mark, right? So into that 20% area, 22% there. So when you look at that, you can see here's the odds of one rate cut, this green line. The odds of 2 rate cuts have gone up to the point where now, combined with this 3 rate cuts here moving higher, that's almost up to 80%. Almost. For January, it is above 80% actually. So you can see all these numbers. The red line is the current level, and you can see it's now down below 20%. As all these lines are rising. So, we're getting pretty decent odds of, at least one rate cut by January of next year. And again, that's usually, once we get those, that's been in the past when the market, the stock market at least, starts to turn over and more of a longer term bearish trend. Until then, because again, these can change. Obviously, we have 6-7 months until we get to that point. But until then, those numbers can change. But if they end up staying right around 80% by then, and we end up getting that rate cut, then that won't be necessarily the most bullish sign. Until then, it is, as we've seen in the past. As long as there is no cut yet, when the market's pricing in the cut that we don't get yet, then we've seen in the past that that's been a pretty bullish environment. Even if the yield curve is inverted, that tends to be, for that, at least in the last period of time, when we go back here, let's go back to a longer time frame. Oh, I had to go back further in 2007, don't I? So if I go back to this time frame again, you can see we had about a year here where we first inverted to the time that we got our first cut, which was right in September of 07 where my cursor is. And you can see the market was pricing in that cut for a few months before, by pushing all these lines down, similar to kind of what we're getting here. But you also notice that the stock market peaked in October of 07. So from that period when we inverted to October of 07, the market's rallied about 20%, and that's similar to what we're getting now, even though we haven't quite inverted on the 2s and 10s quite yet. Take a quick look at the news today. The only really indicator that came out today was durable goods orders. And the year-over-year figure is the most important one, of course. And you notice it's now getting close to crossing below zero. That's kept the economic surprise index down in the strong negative area. But you notice that the rest of the global economic indicators has made quite a big jump up to 18. You can't really see that because we're not really zoomed in on this chart. But minus 18, this is, you can see each little notch here is minus 10, minus 20. So we've really made the jump up here today to get up to, the lowest, the best negative result that we've seen in a while. So that could be this coming off of these strong low points on the U.S. as well as the G10 from an economic perspective, and keeping the GDP figures, close to around that 2% mark, to around inflation. That might be what pushes stocks higher again, because we've been so oversold with for the international markets throughout most of 2018 into 2019. In fact, if you take a look at those international markets here, and take a look here on the left-hand side as well, you can see emerging markets really kind of bouncing up, but China's really struggling. India continuing to bounce up really strongly. Korea struggling closer to 3-month lows. You can see what Brazil's doing. UK bouncing off of its oversold cluster that it got. Germany and Italy and France all bouncing up as well from a developed market standpoint. There's Japan. So we've been really bearish on a lot of these, to the point where we're very far away from these 30-day moving averages. And now there's a good chance that we might bounce off of these, and that could bring the U.S. market up with them. And the U.S. might not, and depending upon what the dollar does, if the dollar falls, you wouldn't expect the U.S. market to gain as much as these. But when you look at how far down these other major economies are, you would expect that they would bounce up more. But that would also mean that the stock market will come up too. So any bounce we get might be actually led higher by these really oversold international markets. All right. If we take a look at the sector performance today, and you can see, looks like the asset chart showed kind of a risk-off week. So does this chart. In fact, if I were to go back the last 3 weeks, because remember we've had 3 weeks on the we've had 3 weeks of bearishness. You can see here's our bearishness in equities, led by all these cyclical moves, sectors to the downside. But you notice during those 3 weeks, utilities, real estate, and staples are all higher, and healthcare is showing a very small loss. So really good outperformance in these safe haven areas, with some underperformance here. And again, eventually we'd expect that to reverse, especially considering, how that these didn't come down, right? If we're really getting bearish, you would expect these to come down too, just not to the same extent. Everything falls off the cliff when the market gets bearish. But you notice that's not the case. As the market's been falling, utilities, in fact, the purple line's been rising, and staples been holding steady, and real estate fell initially, and then it rose while the market continued to fall. So, that's a good sign for the markets that, again, this is just a risk-off pullback move, and eventually you'd expect these cyclical areas to bounce back up. They've had such strong gains. Over the past year, the safe haven areas have really held up really well. But look at, technology and discretionary, doing really well too right there. They've pulled back and given up some of those gains, and now we expect them to bounce. And we really would expect these dollar-sensitive areas, energy, materials, and to a smaller extent industrials, to bounce up as well, assuming the dollar starts to pull back more aggressively. All right, another one of those stocks that's sectors, the healthcare sector, we've kind of focused on here lately for some trades. Another stock in that sector is making a nice, good turnaround is United Healthcare. We actually looked at United Healthcare for a bearish trade in class back in here, and we didn't expect it would drop nearly that much that fast, but the whole sector was dropping hard off of these falling moving average here. Well, since then we've reversed itself. In fact, you see here earlier this week on Monday we had a little bit of a breakout move above this 240 level, and then now pulling back. You can kind of see what that looks like on its Bollinger Bands chart. UNH here, you can see the breakout above the upper Bollinger Band, and you can see there's a lot of volume in here, so I'm not like expecting this huge move to the upside. But nice good breakout from an area where there was very little volume back into this strong volume node. And then you look at some other indicators like the DMI, its positive line getting above 25 for the first time in a while after being so bearish. Its negative line below 20, so that's a good bullish combination there. When you look at its 3 green arrow chart here, let's look at the regular 3 green arrows first. Then we'll look at the 2-line versions. You can see we got 3 green arrows with a rising moving average now. When you look at it on its 2-line version, you can see we're easily above 0 and above 50 on the actual lines themselves. So, and the 8 and the 17 are rising, and they've crossed above the 30. The 30 is rising now. So nice, good move higher for UNH. We can say, okay, well, again, the market posture necessarily isn't strongly bullish yet. So I don't want to be aggressive here on a bullish trade, but we do know that there's some support below us, so I can sell a put near that support at 242.5, buy the 237.5 for some protection. And depending upon where I get filled in at, you see it's an expensive stock, so there's going to be a relatively wide spread. So you can kind of fiddle around to see where you get filled in at here. But the break even, so if I analyze that trade, you can see where the break even is. And again, I'd be willing to lose 100. I'm trying to make 135 bucks. I'd be willing to lose 135 bucks. And you notice I can get half of that 135 pretty quickly, with the other half that would take a lot longer. So if I can get half of that relatively quickly, that 135, being willing to lose that full 135, it would take, we'd have to basically nullify Monday's breakout and get back below these 8 and 17-day moving averages for me to get to that point where I would take that small loss. So again, it's a good sector that's been turning around that was so, bearish itself. In fact, if you go back to this sector comparison and we go back to like a 6-month chart here, you can see healthcare during this time was so bearish, but now it's starting to recover a little bit. And really from that 417 low point, if I were to change this to 417 for healthcare up until now, and we'll go back to a daily chart, you can see it's right up there with these other safe haven asset classes. It's showing some relative strength, especially versus all these other cyclical areas and these dollar sensitive areas down here at the very, very bottom. So it's a way for us to kind of be bullish in an area while the market's still relatively noisy, in a stock where the stock doesn't have to go up. If it goes up, great, I can get out quickly with a small gain. But as long as it stays up, that's what will make the money for that type of trade that we're making on that stock. All right, with that said, that wraps us up for today. You've heard from me now. I want to hear from you. Use that link above the video and on the blog post that will take you to our Market Outlook forums. There's also a link right up there that will take you there. Remember, you have to subscribe to our site to participate there, but you can do that for free. And join our community on our site. We'd love to have you there. Make sure when you do get into the forums, open up any new threads with any questions or comments you have about what we talked about today in the video or anything we didn't cover. that pertains to this discussion, let me know. And remember, you can also reply to other people's threads as well and keep that conversation going. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment on the video. Follow us on Twitter for more content in between videos, and join our community on our website, marketscholars.com, as well as on Facebook. Have a great Memorial Day weekend, everybody. Have a happy holiday, and we'll see you all next week.